After natural gas recently bottomed here at $2.7, we've seen that new bullish trend forming out with this recent high here at $3.5. We've seen all of that coinciding to a divergence occurring where natural gas prices have moved to the upside and cumulative volume delta to the downside. And so in today's video, we discuss why this is currently happening and what might be happening next year to natural gas. Let's first have a look at the geopolitics and then at the fundamentals to really understand the key drivers of natural gas. Well, what we're currently seeing happening in this Gulf region is obviously quite inflationary. We are seeing supply disruptions because in the last 14 months, we've actually seen that the volumes of crude oil and LNG that have flowed via the Strait of Hormuz are actually quite high, right? We are seeing Qatar actually exporting 195 million cubic meters of liquefied natural gas. But why aren't we seeing those inflationary price surges here at natural gas as we're seeing it happen to oil? Well, this might be the case because we're seeing a lot of that actually going to China. We are seeing 51.3 million cubic meters of those 195 million cubic meters that have been exported from Qatar in this time period. We have actually seen a lot of that going to China and to Asia in general. Just 22.7 have been going to Europe. And so that is certainly less than what we're seeing going to Asia, and also the United States isn't even on this list here. And so what you have to argue at this point is that this inflationary pressure that is currently entering the market, that isn't really triggering U.S. markets to higher prices, because as we've just told you, a lot of it is actually going to China, a lot of it is actually going to Asia, and in fact they are quite dependent on liquefied natural gas coming from the Gulf region. You're seeing that 100% of what Pakistan is importing in liquefied natural gas is actually coming from the Gulf region, in fact from Qatar in this case. And you do see that all of those other Asian countries are actually quite dependent on those Gulf states. Now, this isn't really the case with the United States, and so this is why we argue at Chronos that we are not really seeing those inflationary pressures happening to the American natural gas prices. And this can also be explained because we are obviously seeing that the Dutch natural gas prices or the Asian LNG prices are certainly surging much higher and much stronger as what we are seeing happening to the European and also to the American markets right now. And so to really understand what is currently happening, we like to take a look at the broader cycles now, at the weekly chart of natural gas. And what we've prepared here for you is really, really important, and it really explains what is currently happening. And so if you appreciate this this effort, please make sure to subscribe to our channel, like the video, and also comment down below if you have any questions or just want to give us your opinion concerning the topic. Now, what you can see here on the screen is the ratio between gold and the oil prices, as well as the stochastic RSI. And so what you can see here are the last few tops at natural gas and the last few bottoms here in blue at natural gas. And we've marked those tops, those really primary tops with those orange lines here. And what you can actually see is that previous to those tops, we've seen a divergence happening to the gold to oil ratio and natural gas. In other words, we've seen those price surges here at natural gas to the upside before those tops have been in, before those crashes ultimately occurred. And that has actually coincided to the gold to oil ratio move to the downside. Okay, this is really important. That does mean that we do actually see oil outperform gold before those crashes happened, before those sell-offs occurred. Now, you may have already guessed it, we are currently seeing oil prices also outperforming nearly everything with this Gulf war here now. And so that obviously really puts it all together. This really perfectly fits into this pattern that we're seeing here happening. And in fact, ultimately, after we've seen this correlation, this divergence happening, we have actually seen that this reversed. We've seen a bottom forming out at this ratio. We've ultimately seen that gold started to outperform oil. And historically, whenever that started to be the case, that actually marked the top at natural gas. Now, we have seen that long stretching bullish trend since this low here in 2024. And we at Chronos argue, as we are currently seeing history repeat, as we've seen this top forming out, as we've seen now those oil prices surge, this is actually perfectly aligning. And in addition to that, what we like to take a look at as well is the stochastic RSI. And you can see that historically, whenever we've hit this 100 level, this trend line at 100, which we've marked with this gray line here, that historically marked the major tops that we've seen happening. Now, there has to be a word said about this, because we do see in the last few cycles that this has actually differed a little bit. We have actually seen two highs form out, but the first one was certainly a lower high, and then we've seen a higher high. But we've actually reached this trend line twice, and that happened for several times here. And we argue that this is just a different kind of appearance, but it certainly stays quite similar. We're also seeing those two retests of this upper trend line here, one time in January 25, and also this recent high here in November 2025. And we argue at Chronos that this might be the beginning of a bear market. And we have some additional information that also backs this thesis, which is this chart here. This first seems quite complicated, but it's actually quite simple. We do have the S&P 500 divided by the unemployment rate squared, multiplied by the US inflation rate year over year, multiplied by the US interest rates, and that is divided by the M2 money supply. And so eventually you do not really have to understand this perfectly, but for example, we have this correlation where this chart is obviously moving to the downside as the unemployment rate is, for example, rising, because this is the denominator. It is divided by, or the S&P is divided by this, and so as this is growing, obviously this chart is going down. Now we also have the inflation rate, obviously, that tends to move up, and the interest rates also tend to first being slashed down, and obviously the money supply is certainly also a really important metric to really put it all together. Now, what you can see here is historically, whenever we've seen that ratio fall, we've seen those recessions actually occur, beautifully marked by those red areas here. And we've seen that ratio fall for quite some time now. And so we argue that this is just a matter of time that we do see a recession appear here once again, as it happened historically with a hit rate of nearly 100%, we argue. Obviously, there are some examples that this hasn't really perfectly happened, but essentially when you start to see this ratio fall, that has certainly always been a good signal for a recession. And that is what we argue in this video. We argue that what we're currently seeing here with the oil and gas prices certainly is affecting also the American markets, but we have seen that this is certainly not happening to such of a magnitude as we're seeing it happen to European and Asian markets, as those are really dependent on liquefied natural gas from the Gulf region. Now, concerning those historical data points that we've just assessed, concerning this empirical evidence, we at Chronos believe that this is certainly the end of this bull market here concerning natural gas, and that we might be seeing lower prices happening quite soon. Now, obviously, we are in this short-term bullish rally since this low here in February 2026, 26th of February. And so that is, we have to keep in mind that this is still a valid structure, but we argue that this could also reverse quite soon. We could, for example, form out a symmetrical triangle here, with this being the high, and then we do have this basically as resistance here. Now, this is just one possible point. one possible scenario. But I hope you understand why we are currently quite bearish and why we obviously believe that there is limited upside in the short term as well. So if you have any questions, don't hesitate to ask them down below in the comments. Please make sure to subscribe to our channel and like the video so you support us, and also don't miss future videos. Check out our Discord server, which is also linked down below. Yeah, thanks for your support in this community. See you the next time. Bye bye.